Nobody teaches you the truth about money. I spent 6 years studying at an economics faculty and still didn't understand it. I spent 9 years reading every serious finance book I could find, 15 years in total, and it contradicted almost everything I was taught. So one day, I went back to the university professor I trusted most, and I asked him if what I was discovering on my own was actually true. He looked at me and said, "Yes, all of it." He knew the reality of the system, but the textbook we were using said otherwise. That is when I understood that the confusion isn't an accident. To get a perfectly clear map of how money actually works, we have to start from zero. We have to step outside of modern finance entirely, travel back to 1903, and look at currency in its most absurd, heavy, and physical form. In 1903, an American doctor named William Furness travels to a tiny island called Yap. It is a small piece of land isolated in the middle of the Pacific Ocean. And he is completely confused by what he sees. The people of Yap use enormous stone discs as money. Some of them are 4 tons of solid limestone, roughly the weight of an elephant. You cannot carry them, you cannot move them. They sit there in the village, by the road, or outside someone's house, permanently locked into the dirt. Here is the bizarre part. When someone buys something, the physical money never ever moves. Ownership transfers, but the stone stays exactly where it is. Everyone in the village simply agrees that the stone now belongs to a new family. The physical location of the limestone is irrelevant. Purchasing power is completely divorced from physical possession. The system gets even stranger. Years prior, one Yapese family was transporting a particularly massive stone by canoe. A severe storm hit during the trip. The canoe tipped over, and the limestone sank to the bottom of the ocean. Nobody can pull it out. Nobody can even see it. It is entirely erased from the physical world, yet it still kept circulating as money. The entire island agreed that the stone exists, and they know who it belongs to. Because of that shared memory, that family could freely spend it. The community's collective mind functions as a perfectly accurate, invisible bank. The stone itself was never the point. The agreement was. 2 of the greatest economists in history, John Maynard Keynes and Milton Friedman, spent their entire lives arguing. They disagreed on almost every policy imaginable, yet both of them independently read the accounts of Yap Island, and both of them came to the exact same conclusion. They realized these islanders understand money better than we do. The mechanics of that invisible, sunken stone at the bottom of the Pacific Ocean perfectly describe the balance on your banking app and the paper cash sitting in your pocket. Money has never been a physical object you hold. It is entirely a shared, invisible ledger that you trust. Most people imagine the origin of trade as a simple swap. You have fish but need bread. I have bread but need fish. We assume that as these swaps became too complicated, we eventually invented coins to simplify the exchange. This story comes from a logical argument economist Adam Smith wrote in 1776. At the time, he wasn't recording a historical observation, but proposing a theory for how a market might develop from scratch. For 250 years, this theory was repeated in textbooks and class rounds as established fact. Because the logic seemed sound, generations of economists and teachers accepted the narrative without checking the archaeological record for evidence. By relying on this unchecked thought experiment, we built an entire modern understanding of global commerce on a scenario that lacks any supporting historical data. When anthropologists finally went looking for the barter society Smith described, they found a void. Cambridge researcher Caroline Humphrey spent her career searching for a real-world example of a barter economy as a foundational system. Her research found no evidence that such a system ever existed. No society has ever been described using a barter economy. Not in any culture, not in any era, and not on this planet. This creates a massive paradox. If the story of the fish for bread swap is a fiction, we have to rethink the timeline of how humans actually began trading resources. Removing the barter myth leaves a gap in the history of human civilization. If money didn't evolve to solve the problems of swapping goods, we have to ask what actually came first. In early communities, economic life functioned through cooperation rather than immediate trade. If a neighbor needed help building a roof, you provided the labor. with the simple understanding that they would help you with your harvest later in the year. These interactions involved no physical currency and no immediate exchange of objects. There was no haggling over the value of a roof versus the value of a field of grain. Trust and accountability were maintained through collective memory. People simply remembered who they owed and who owed them. This network of social obligations and promises served as the first currency. It was an invisible ledger held together by the community itself. As small villages grew into sprawling, anonymous cities in ancient Mesopotamia, the human brain could no longer track thousands of individual favors. Relying on memory became impossible when dealing with strangers in a crowded urban center. To solve this problem of scale, humans invented the earliest known form of writing. Long before poetry or religion, writing served a purely administrative purpose. These 5,000-year-old clay tablets from modern-day Iraq are debt records, physical evidence of how cities functioned before cash. Merchants used these to record loans, paired with promises to pay back after harvest. Each scratch represents a social obligation tracked across time. These clay ledgers existed for more than 2,000 years before the first physical coins were ever minted. Humanity ran entire civilizations and complex urban economies on recorded promises alone. This period shows that trust and debt are more foundational to our history than coins and bills. The late arrival of the first coins in Lydia, in modern-day Turkey, confirms that physical currency is a relatively recent addition to human trade. This forces us to re-examine the barter myth and ask when people actually do trade fish for bread directly. Physical barter typically emerges only when a society's established system of money and trust collapses. When the currency in Russia disappeared in the 1990s, or when banks failed in Argentina in 2002, people went back to swapping things directly. History suggests barter serves as an emergency backup, appearing only when the technology of money fails and trust between citizens dissolves. We see this same logic in the massive stone discs of Yap Island. Like the clay tablets of Mesopotamia, these stones were rarely moved. Instead, the community simply kept track of who owned which portion of the stone's value. The evidence from these two isolated cultures shows that the physical object, whether a clay tablet or a giant stone, has no inherent economic value. Money functions as a conceptual measuring tool, much like a ruler. It was designed to measure and track the agreements we make with one another. Since its inception, money has been the technology we use to record our promises. Modern digital bank accounts are simply a more efficient version of the scratches in ancient clay. Think about a minute. Whether you're in Tokyo, New York, or Cairo, a minute is exactly 60 seconds. Nobody wakes up and decides a minute is now 55 seconds. It is a fixed, universal measurement that no human being can alter. For thousands of years, money worked exactly the same way. It was tied to naturally scarce physical anchors like gold and silver. It was heavy, solid, and impossible to print. That physical reality is what kept everyone honest. Moving to paper currency meant trading that natural, mathematical security for blind trust in the exact same institutions that benefit from manipulating it. So why did we do it? Why did humanity willingly surrender the absolute safety of hard metal for a system based on easily exploited pieces of paper? It is easy to look back and assume it was a terrible mistake, but placed in those same historical conditions, you would have been the one demanding a paper alternative. Understanding this shift shows us that adopting paper money was perfectly rational. It was a desperate response to an unbearable economic problem. About 1,000 years ago, during the Song Dynasty, the isolated Sichuan Basin in China had a highly unusual official currency. Their money was made of solid iron. But iron has a fatal economic flaw. It has an incredibly low value compared to its massive weight. To conduct even the most basic trade, merchants were forced into hauling kilos of metal across vast, dangerous territories. Moving that physical money was slow and exhausting. It created a severe bottleneck, making rapid trade and business scaling virtually impossible across the empire. There comes a breaking point where the safety of a hard asset is entirely outweighed by the literal exhaustion of trying to use it. Ordinary merchants came up with a practical solution. They started leaving their heavy iron at trusted local shops in exchange for lightweight, verifiable paper receipts. Instead of moving the metal, They traded the receipts. It was vastly faster, entirely weightless, and eliminated the constant threat of highway robbery. The system worked entirely on one rule. A single paper receipt was universally trusted to equal an exact, retrievable weight of iron held in the vault. Once that physical weight was removed from the equation, local transaction velocity and economic prosperity exploded. Trade flowed effortlessly. The government took notice of the system's efficiency and moved to absorb the private shop networks. They stepped in and officially issued the world's first centralized, state-backed paper money, known as jiaozi. Moving from natural scarcity to human trust was celebrated as a massive technological leap. It completely solved the brutal friction of physical trade. But then came the crisis. The state needed immense capital to wage its wars, and physically extracting new iron or silver from the earth is slow and labor-intensive. Printing paper, on the other hand, costs almost nothing and takes seconds. The state quietly began printing vastly more paper receipts than the actual volume of iron they held in their vaults. This chart maps out the inevitable math. As unbacked paper floods the market, the purchasing power of each individual note crashes toward zero. Once the merchants realized the measuring stick had been shortened, trust evaporated entirely. Society was forced back to the grueling iron coins they spent generations trying to escape. The Chinese were the brilliant inventors of paper money, but they were also the first civilization to be economically destroyed by it. We adopted paper money because it made trade effortless, but by stripping away the physical friction, we permanently surrendered our natural defense against the silent manipulation of our wealth. When you deposit money into a bank today, you naturally assume it goes straight into a vault to sit there, safely waiting for you to come back and collect it. But that money isn't sitting in a vault at all. To figure out where it actually goes, we have to look at a very specific loophole discovered back in the 17th century. Imagine living in London in the 1600s. The streets are dangerous, thieves are everywhere, and the constant threat of city fires and wars meant keeping your savings at home was an incredible risk. Look at these heavy gold coins. Storing wealth back then meant dealing with massive physical weight, and protecting it from being stolen or destroyed was a daily struggle that could end in complete ruin. Banking emerged as a tool for physical survival, a desperate response to the need for security in an era where losing sight of your assets meant losing everything. The local goldsmiths already had heavily fortified vaults for their jewelry businesses. So citizens started paying them a small fee to store their gold in these existing strongboxes. In exchange for handing over the physical metal, the depositor received a simple piece of paper, a written receipt stating exactly how much gold was locked away. Since almost everyone in town used the same goldsmith, people realized something. Instead of hauling a heavy bag of gold across town to buy goods, it was 10 times easier to just hand the merchant the paper receipt. One night, a goldsmith realized that while his vaults were completely full, about 90% of that gold was just sitting there collecting dust, because his customers were only trading the paper. The convenience of using paper effectively detached physical gold from the day-to-day idea of wealth. This created a massive, invisible pool of idle capital, completely unmonitored and waiting to be exploited. The goldsmith decided to quietly lend out a portion of that idle gold to merchants and charge interest on the loan, all without ever telling the true owners. Think of paying to park your car in a secure garage. The owner secretly drives it as a taxi, collects the fares, and parks it back before morning. But if the taxi crashes, you lose your property, while the garage owner keeps the profits. The goldsmith captured all the financial reward from the interest, while the original depositor carried all the risk for an asset they believed was safely locked inside a vault. But here is the strange part. This deception was actually useful. Loaning out that idle gold provided the exact capital merchants needed to start businesses and create jobs that otherwise wouldn't have existed. What started as a localized scam proved an essential economic point. Gold sitting in a box does nothing, but capital put to work filled cities. But the goldsmith didn't stop there. He soon realized he didn't even need to move the physical gold out of the vault. He could just write out new paper receipts and lend those instead. The vault holds exactly 100 pieces of physical gold, but the goldsmith prints 150 paper receipts. The 50 extra receipts have zero gold backing them. Yet, because the real and fake receipts are visually identical, the deception is entirely invisible. Soon, unexplained inflation began to creep through the town. Prices rose simply because there was suddenly too much paper circulating and chasing the exact same amount of goods. The system's most dangerous flaw emerged as soon as human greed realized it could bypass its physical limits. When the missing gold and the extra paper receipts were finally exposed, you might expect the public to demand criminal trials, outrage, and severe systemic reform. Instead, King William III stepped in. But he didn't shut the fraud down. He looked at the mechanics of the scheme and decided to co-opt its power for himself. The king was desperate for capital to fund his ongoing wars, and traditional lenders had completely refused to finance him. In 1694, he struck a deal. A group of merchants loaned the crown £1.2 million. In exchange, the king granted them an official, exclusive license to print paper money. In one stroke of a royal pen, a localized criminal deception was legitimized and transformed into a state-sanctioned financial institution. Look at this document. This is a Bank of England note from 1699. Notice the cursive text at the top. It explicitly states, "I promise to pay." It is a debt instrument backed merely by a king's promise, not a receipt for gold storage. The government took what the goldsmith originally called a fake receipt, rebranded it, and officially named it a banknote. Different name, exact same trick. The rest of the world watched the British Crown generate limitless financial power and immediately began copying the Bank of England's model within their own borders. This exact mechanism is still running today. Every modern central bank and local branch you walk into operates on this precise system of fractional lending, creating money out of thin air. The entire foundation of the modern global economy is simply a legally protected, state-sponsored version of a 17th century goldsmith lying awake in bed, realizing he could lend what wasn't his. If you held a $100 bill in 1971, it represented a specific amount of purchasing power. Today, that same piece of paper buys only $8 worth of those same goods. This decline began with a global agreement in 1944. To stabilize the post-war world, Western nations tied their currencies to the US dollar, which was itself anchored to physical gold at a fixed rate of $35 per ounce. For decades, this system held, but a gap eventually formed. While the United States printed paper dollars to fund foreign wars and social programs, the physical gold reserves remained finite and unchanged. When other countries realized the volume of paper in circulation far exceeded the gold held in American vaults, they began demanding their physical metal back, rapidly depleting the reserves. On a Sunday evening in August 1971, the U.S. president announced that the dollar would no longer be convertible to gold, ending the currency's last physical connection to a tangible asset. Since that broadcast, every currency on Earth has functioned as paper backed by nothing but a collective promise of trust. Economics textbooks often describe banks as simple intermediaries, institutions that take in the savings of one customer to lend them out to another. In the modern economy, 97% of the money supply is digital, and it is created by private banks rather than central governments. This diagram shows a bank's internal ledger during a loan. When you borrow $10,000, the bank does not move existing money into your account. Instead, it records your loan contract as an asset and simply types $10,000 into your balance. The act of signing that contract is what causes the money to materialize. Your legal promise to pay is the catalyst for the creation of new currency. If you borrow $10,000 at interest, you might eventually owe back $11,000. However, while the bank created the initial $10,000, it never created the extra $1,000 required for the interest. To find the money for that interest, the system requires a second person to take out a new, larger loan. This cycle repeats indefinitely, with each new debt providing the liquidity to pay off the old interest. Because the total supply of money must expand to prevent mass defaults, the volume of digital dollars in the system grows faster than the actual goods and services available to buy. This mathematical requirement ensures that each individual dollar loses a portion of its value every day, just to keep the debt structure from seizing.
Inside institutions like this one, the steady devaluation of currency is monitored and managed as a core objective of the financial system. Major central banks worldwide operate with a specific mandate to target a 2% yearly inflation rate, a policy they describe as price stability. This chart tracks the value of savings under that 2% target. Over a 35-year period, the compounding effect of that policy cuts the purchasing power of your savings exactly in half. If the yardstick used to measure value is shortened by design every year, we must look at who the system was built for. Inflation benefits the borrower. It allows a person or institution to take on debt in today's strong currency, but settle that debt years later with money that has become significantly weaker. The largest borrowers on Earth are national governments. They carry debts so large they can never realistically be repaid, meaning the only way to manage the obligation is to inflate the value of the currency away over decades. This mechanism effectively transfers wealth from the citizen's savings to erase government debt.